Everywhere I go, I hear investing, but I don't understand what investing is. I don't know what stocks are. I don't want to put my money into something I don't understand. Everyone talks about investment. It's literally everywhere. I hear about it, I read about it, but I don't get it. It just all sounds like jargons to me. What if the market crashes when I invest? Where do I start from? If that sounds like you, come closer. Let's talk about investing in simple English. And if you have further questions, even after this video, you can put it in the comments and I'll be there to answer. Hi everyone, my name is Angel. I'm a finance professional, chartered accountant, and a personal finance content creator. You can call me your personal finance friend, PFF for short. I'm starting an investment series and I'll be talking about what investing is, things to do before investing, the different asset classes you can invest in, and how to actually buy your first stock. So do well to stay tuned, subscribe to this channel if you have not, share this link with someone. It's very lonely at the top, so you don't want to be building wealth and your friend is not building wealth as well. So send this link to someone and let's get right into it. Now, before we talk about investing, let's talk about what investing is not. Number one, investing is not quick money. Yeah, it's not get rich quick, it's not forex flipping, it's not Ponzi schemes like MMM, it's not double your money in 30 days or bring one gets $500 million. Nope, that's not it. If someone or something promises guaranteed high returns in a very short, ridiculous amount of time, just run. That's a red flag. Run. Don't do it. Don't do it. Number two, investing is not gambling. I don't know so much about gambling, but from what I know, gambling is based on luck and short-term outcomes. But investing is based on ownership. Now, when you invest in a company, when you buy a stock of a company, you're buying a small piece of that business. You're owning a part of the business. So it's based on ownership and long-term growth. Number three, investing is not only for the rich. Yeah, I said it. I think there's this misconception that if you don't have a lot of money, you cannot invest. But the truth is, you don't need millions to invest. You don't need to be an expert. You don't need to be a hedge fund manager. You don't need to be an economics graduate or a finance person. You don't have to you don't have to have a certain qualification before you actually start investing. If investing is for everyone, you can start with as little as 5,000 naira, or if you're in the UK, you can start with as little as £10, £50, whatever your capacity is. Do you? But investing is not for the rich. In fact, you get rich by investing. You build wealth by investing. Go and ask the rich, they'll tell you. Now let's talk about what investing actually is. What is investing? Investing is simply putting your money somewhere so it can grow over time. And when I mean somewhere, I mean assets that have the potential to grow over time. And we're going to be looking at different assets later on in this series. Basically, the point of investing is for your money to make more money for you. Now, why should you invest? The main reason you should invest is to hedge against inflation. Now, what is inflation? Inflation is the increase in the prices of goods and services over time. Think of the price of a loaf of bread or internet subscription or even gas, petrol, fuel 5 years ago. Think about the price of it then and now. Obviously, the prices have risen quickly in recent years, right? Now, when prices are rising quickly, it means that inflation is high, and it also means that you can't buy as much with your money. 5 years ago, 1,000 naira could maybe 1,000 naira, 2,000 naira could cook you a good, decent meal. But now it's not the same thing. So you can't buy as much with your money when prices are rising quickly. So the cost of living is higher. But just hold that thought there. Don't let me confuse you. Now, let's say you have some savings of £1,000 or £5,000 or 1 million naira and you leave it in cash for years. It's just lying there in your account. Now, because of inflation, the value of that money reduces over time. One, prices of things will increase. So yes, it may look like, oh, yesterday I had this amount of money in my account. Today I'm having the same amount in my account balance. But trust me, the purchasing power of that money drops. So when I say the purchasing power, meaning what that money can buy reduces. So if you could buy, say, 5 loaves of bread with that money. Today, you can't buy 5 loaves of bread with that money. And I'm just using bread. I'm using bread as an example, not because I'm a foodie. But when you invest in assets like businesses or ETFs, your money has the opportunity to grow. Your money has the opportunity to make more money for you. I want you to see investing like planting a seed. Till today, I'm yet to see a farmer that plants today and harvest tomorrow. When you plant a vegetable seed, for instance, say tomato, you don't plant it today and go tomorrow to say, where's the plant? Where's the stem? Where's the branch? Where's the fruit? You don't do that. You water it, you wait, you allow time to do its work. And after the gestation period, I think it's about 3 months or 6 months. I can't remember my agricultural science now. You get to harvest, right? Now, it's the same with investing. You don't expect to invest in stocks today or buy a house today and expect that, okay, tomorrow the value has doubled. That's magic, right? And we don't do magic here. Investment is not magic. And yes, don't get me wrong, markets go up and down. That's very normal. But if you look at the trend, if you look at the pattern of markets over long periods, you'll see that markets have grown. So you don't lose money when you invest. You don't lose money when you invest. You only lose money because you invest without understanding. So yeah, investing helps to hedge against inflation. Now, before you start investing, there are things you should do. And I'm going to share with you 5 things you should do before investing. Number 1, have a stable income. Investing is long-term. And when I mean long-term, and when I'm talking investing with people, I'm not saying 1 year, 2 years, 3 years. I'm saying 5 years, I'm saying 10 years, I'm saying 15 years. So you don't want to invest your money for rent or your tuition fees or your money for transport or for money for food, money for utilities. That's not what you want to do. So you want to have a stable source of income. You want to know that every month I'm getting this amount of income. The first thing to do before you invest is to stabilize your income. That should be your first priority. Number 2 is build an emergency fund. Now, before investing, aim to have saved for at least 3 to 6 months of living expenses. At least 3 months. If you can save at least 3 months of your living expenses, you can start investing. And now you'd ask me why. If something happens, now no one prays for any bad thing to happen. No one prays for any bad thing to happen. But if something happens, say a medical emergency or even maybe relocation or job loss, you don't want to be caught unawares. You don't want to be unprepared. You don't want to sell your investments in panic and even at a loss. So emergency fund first, build that first, and then investments. Good. Next is pay off high interest debt. There's no point trying to achieve an average of 8 to 10% return in the stock market over the long term when you have a credit card that is charging you 10 to 20% interest rate. That math isn't mathing. So if your credit card or you have a loan of 10%, 5%, 10%, 20% interest, and you're trying to chase 8% long-term returns, mathematically you're losing. Like, it doesn't make any sense. So you need to first prioritize clearing your debt first before investing aggressively. Next is understand your risk tolerance. Before you invest, before you start investing, you need to understand your risk tolerance. The market will fall, prices will go from 100 to maybe 20. There'll be years when your investment drop 10%, 20%, or even more temporarily. You need to ask yourself, can you emotionally handle that? If seeing your money drop makes you panic or gives you anxiety, you need to start slowly and maybe choose diversified funds. But first, you need to understand your risk tolerance. Am I averse to risk? Do I love risk? Am I neutral to risk? So you need to know your level of risk tolerance. Finally, I would say learn the basics. And now I'm not saying you should go to buy a course or enroll for a finance degree. I'm saying understand the basics. Understand what a stock is. Like, I know it could be a lot of jargons and a lot of terms, but as a beginner, you want to have a notepad or a journal where you call it your investment dictionary, your investment diary, have this basic thing. Tell ChatGPT or AI, whatever AI tool you use, explain stocks to me in a very simple way. Of course, which is why I'm also here to explain this thing to you in a very simple way. But you want to understand what exactly is a stock, what is an ETF, what are index funds, what is dividend, what does volatility mean? When they say buy the dip, what does that mean? So you need to understand the basics. You just need clarity. Preparation helps you to prevent panic so that when your stocks are going down or when the value of your investments are going down, you can be relaxed and say, oh no, it's just temporary. I'm in for the long term. I'm in for the long term and we're not going to panic over here. When you've done all of the above, then you can start investing. Found this video helpful? Ensure that you like this video, save it, subscribe to this YouTube channel, and let me know in the comments what asset class you'd like to learn more about in the next videos.